But I'm probably more excited about the precious metals equities. The fact that they haven't done well for the last year is attractive to me, first of all, because the goods are on sale. I'm less excited about a sector where the price has doubled than I am about a sector that's fallen by 10 or 15%, particularly where I think it's going to go up. And I think precious metals are going to go up. How much higher? I don't know. What I can tell you is this. Over the course of my professional career, precious metals and precious metals securities have had about a 1.5% to 2% market share among total savings and investment assets in the United States. Right now, the same number is less than 0.5%. If demand for precious metals and precious metals equities merely returned to mean, if they ignored quantitative easing, debt and deficits, and negative real interest rates, demand for them would triple. And that's precisely what I think is going to happen. The precious metals equities, relative to the free cash flow they're making at today's commodity prices, not the prices that I think the commodities are going to go to, at today's commodity prices, are cheap. Jake, I love cheap. So I'm attracted to the precious metals equities. I'm attracted to the great big ones generating free cash flow. I'm attracted to the somewhat smaller ones that are generating even more free cash flow relative to their market cap, because I think the big ones will take them over. And I love to participate in takeovers. I'm interested in the development stage assets because the industry doesn't have very many good development stage assets in the pipeline, and they'll be taken over too. I'm interested in discoveries. It seems that there's things of interest throughout the precious metals equities landscape. I'm particularly interested because of the poor price performance in silver and silver equities. You'll recall earlier this year they had the silver squeeze, which people suggest now has failed. It hasn't failed. It hasn't gotten started. The real silver squeeze is not about a whole bunch of new young people being attracted to the physical silver market so that they can break the banks. The real silver squeeze is when demand for silver and demand for gold return to their 4-decade median or mean, when current demand grows by 3-fold or 4-fold in a market where silver supply can't increase that much. And our mutual friend, Doug Casey, told me 20 years ago, and it's true today, that the combined market capitalization of the legitimate silver sector is so small that when the generalist money tries to crowd its way into it, it's like, quote, siphoning Hoover Dam through a garden hose. It just doesn't work. So let's talk about why, if all of this is true, nothing has happened yet. In the first instance, investors of my age have been trained over the last 40 years that everything's under control, that no matter what sort of difficulty we get ourselves into, be it the tech wreck of 2000, the liquidity squeeze of 2008, the more recent COVID squeeze, it doesn't matter that the Fed has your back. The problem with that thesis is that the Fed has already spent its easy ammo. Do they take the interest rate below zero? Do you have to go to the bank and give them a toaster to open an account when they used to give you toasters for opening an account? My point is that what worked in the past doesn't necessarily work in the future, but the expectation of the future has been set by investors' experience in the immediate past. And in the immediate past, things just got better and better and better. And if any time things didn't get better, then the Fed came to your rescue, even to the extent of, quote, helicopter money during stimulus, where in a labor short economy, the Fed in their wisdom paid people not to come to work. The circumstance that you're talking about, which is to say the cost of living greatly outpacing average people's ability to earn, is something that is going to occur to people over two or 3 years, which is to say that the paradigm that people use to look at the circumstance that they're experiencing is going to change before your very eyes. We had 40 years to learn that inflation wasn't a problem, that government was our friend. All of those types of things, they didn't happen to be true, at least towards the end of that era, but people believed them to be true. The idea now that people will willingly buy a 10-year treasury will willingly accept a 1.5% return in a currency that's depreciating by 5.5% means that we live in an era where narrative is more important to people than arithmetic. But the truth is, Jake, over time, arithmetic always wins. But many people have said to me, Rick, this bull market is by your reckoning already long of tooth. It's already 4 years old. They say the same thing to Eric. Both of us point out that the two prior bull markets in our career were 10 or 11-year bull markets, which is to say, we aren't halfway through. And in terms of dimension, people say, well, the silver price has already gone from, $14 to $22 or $23, well, 30 on its way, and then on its way back down. Hasn't the easy money been made? Well, in the first bull market of my life, the silver price went from $1.50 to $50. In the second bull market of my life, silver went from a more advanced $5 to $50, which is to say, a 10-bagger. So when people say to me that the bull market has run its course, either by way of duration or dimension, I say to them, perhaps you're not as old as me. Perhaps you haven't studied history, or perhaps you were just a lousy student. But the truth is that I think that the precious metals bull market is not at its midway point, that wind is in the sails of precious metals. And I have noticed in prior precious metals bull markets that the first half of the bull market was gold-centric, and the second half of the bull market was silver-centric. And when the momentum was established by gold, then silver picked up. And when the silver was established by the momentum occurred in physical silver, then the silver stocks, at least the high quality ones, not the junkers, but the high quality ones, really surprised people with the extent and the rapidity of the rise. The writing is absolutely on the wall with precious metals. History teaches us that when momentum is in precious metals, the market becomes silver dominant. And history teaches us too that the most explosive asset class in precious metals is silver equities. The price of the high quality silver producers has in many circumstances fallen by 30 or 40%. And the prices of many of the juniors have fallen by 75%. Most people believe that everybody else is responsible for their outcome. That's a recipe for disaster. The fact, first of all, that you recognize a problem means that you will outcompete 80% of the population who doesn't even understand that there's a problem or that they're in a race with fate, which they are. Remember the great words of Warren Buffett. He said he made money by being brave when others were afraid and afraid when others were brave. He liked and likes assets that make arithmetic sense that are unpopular. Unpopular. He was willing to buy straw hats in winter when you didn't need protection from the sun. Important, too, to care about probabilities. What are the probabilities that precious metals react as they have historically to a circumstance where other forms of savings are being debased constantly and are likely to continue to be debased constantly because of the reality that most people believe the government's job is to subsidize them? To me, the idea that the government is able to end artificially low interest rates, that the government is able to end counterfeiting, quantitative easing, the idea that the government is able to service $150 trillion in on-balance sheet and off-balance sheet liabilities with a budget that's in deficit by $4 trillion a year. The probability of any of those things occurring is zero. The likely outcome of a continuation of the circumstance that we live in, likely, I would say overwhelmingly likely, is that precious metals will do well. When? I don't know. And frankly, since I don't know and I don't have any way of knowing, I don't care. If I believe an outcome is absolutely positively inevitable, and I think that the penalty for ignoring that outcome is severe, And the reward for anticipating that outcome is extraordinary, that I owe it to myself, that I owe it to my family, that I owe it to my tribe, that I owe it to my future to anticipate that situation, pay attention to the probabilities, and act. And I think you have that right too. Von Mises talks a lot about human behavior, and he talks about recency bias. He talks about the fact that our expectation of the future is set by our experience in the immediate rather than the distant past, which means that we're all poor students of history, that we're victims of emotion rather than beneficiaries of rational thinking. When the silver price a couple of years ago ran from $15 to $28, in the $15 time frame, there was no interest. At the $26, $27, $25 time frame, 25 to 28, people were fascinated. So they missed $15. They bought $27. When the silver price declined to 21 or 22, down from 29. In other words, when it became a better buy, they became disgusted. A generalist investor who doesn't want to take much risk and doesn't want to do much work should buy the best of the best. He or her should buy, the Franklin Nevadas and the Barracks of the world. The people who are willing to take a bit more risk but want more reward need to look at the mid cap, sort of $2 billion to $6-7 billion. Those companies are as cheap as I have ever seen them in my life, and they're either going to go up in price or they're going to be taken over. And if, as I believe, the gold and silver prices go up, in addition to the fact that they're cheap now at current commodity prices, they'll seem like extraordinary bargains if the gold and silver prices go to where I think they're going to go. But for those who are willing to take 50% risk in order to generate 500 or 600% returns, I think we're coming into a 2 or 3 year period of time frame where people who are psychologically and financially equipped can do very, very, very well in hard speculation, intelligent speculation. The subset that interests me the most is silver, because the database is intact. You know from 40 years experience where the deposits are, who the people are, what strategies work. I'm also attracted now particularly to that subset of metals that they're calling battery or electric metals. There's a lot of interest in the theme, but the people who are interested don't know how to apply the knowledge, which is something I absolutely love. I believe that we are going to continue for 30 years in an electric era, not merely because of things like Teslas, but rather because 1.6 billion people on Earth have no access to electricity at all, but they're going to have it in the next 15 years. And also because another 2 billion people on Earth have intermittent or for them unaffordable access to electricity. So demand for electricity is going to grow. I'm interested in the other battery metals. I'm interested in nickel sulfides. I'm interested in the high quality copper stocks, although the copper theme is getting beat pretty hard right now. I'm very interested in cobalt because I'm willing to take political risk. I understand that in order for me to buy cobalt, I have to buy Russian stocks and I have to buy mines in Congo, both of which I'm willing to do. Owning oil and gas stocks. Yes, the oil price has gone from 20 to 80, but so many people believe that the whole world is going to switch to Tesla by January. And so many other people are concerned about the fact that Biden and Greta and all those big thinkers don't like oil, that the oil companies are discounting $55 oil and $3 gas in a world where oil is selling for 80 and gas is selling for $5.50. If the oil and gas prices hold above $60 and $3.50 respectively, these stocks as a source of sustainable dividends are cheap and will continue to be cheap. And you don't need to go too far down the quality trail there. You can play that game just by buying Exxon. There are a lot of people who see things very differently than me. And I think their outcome over the next 3 to 5 years is going to be very bad. And I think that their response to me doing well while they do poorly will not be to blame themselves for being lethargic sloths, but rather to blame me for being an applied, aggressive thinker and actor. That's what bothers me.